All right. What's going on? Just trying to let a couple people come in since I just put the alert out. Now, the good thing is, and people weren't really expecting me to have a stream today, so not a lot of people are showing up. But once Tim comes in and starts streaming on Mondays and Wednesdays in my normal stream spot, that's really going to free me up so that we can come in and do afternoon streams more often. The way it used to be, I used to come in the afternoons and we would build out trades and put on trades. And I think people really liked this because they knew they weren't in it alone, right? A lot of people are kind of new to options and they're worried they're going to get into it and then they don't know what to do with it. Maybe they don't quite understand their risk. But if you know that you're not the only one in it, that we're all in the same trade and we review what the risk looks like, then seems like people are more comfortable with it. You know, that's the idea. All right, so let's go ahead and get started. When I was new, I wanted a watch list that was easy enough to kind of manage and keep track of, nothing too big, no scanners required. And the Dow Jones Industrial Average is a really good source, right? It's well defined, got names that you're familiar with, has liquid options. And since when we're trading options, we can trade long, short, sideways, we can literally trade anything we want. Every single chart we pull up is a trade opportunity, as long as it meets some distinguishing characteristics, one of those being earnings. And that's going to be the biggest thing that we struggle with today, is we're going to get close to that earnings, right? We're there. We're pretty darn close now. So Apple, for an example, at the end of January. Now, my go-to is I want to stay far enough away that I do not get tangled into options that are going to be expiring within that options expiration of earnings. And the reason for that, and I've done examples of why, the Greeks are manipulated when we trade options that are going to expire during that earnings event. Plus, there is the idea that, well, we just don't know what's going to happen at earnings. Don't ever fool yourself into thinking you know what is going to happen at earnings. You can say, oh man, they had a blowout quarter, you know, oh, it's Christmas and they sell things, and it doesn't matter what they did this quarter. It does, but that's only a part of it, right? It's what are they going to do next quarter? And when they have their earnings announcement, when they say, we think we're going to make X amount of money next quarter, that can topple a stock or send it skyrocketing. And they keep that as a close guarded secret. So you can look at a market and say, oh, I think they had an amazing quarter. Yes. But when they report, you don't know what they're going to report. So we have to be careful with earnings. And the example that I always use when it comes to earnings is Facebook. My first year, when I was new to trading, 2018, some college kids traded Apple and they became millionaires overnight. These college kids took every last dollar they had, put it into an Apple trade at earnings, and had an amazing blowout earnings. And so some guy out there decided, oh, I'm going to do that with Facebook. And it didn't work out too good for them. So here's 2021, here's 2020, 2019, 2018. That earnings right there, where Facebook dropped from here to there. Unfortunately, that guy didn't live in America, and whatever country he did live in, he didn't have the money to pay for this trade. So the brokerage started billing everybody else, because the brokerage is really the one on the hook. They were in debt to their eyeballs. Goodness knows what happened to that guy. You know, in America, if you do something like that, you're going to get sued, and maybe you lose your home. You know, like, you know, there's consequences, but you're not going to get beat down and taken to prison and have your life taken away from you. That guy, I don't know whatever happened to him, but you can imagine it wasn't anything good. You know why Facebook dropped that hard? Because they were making 21% quarterly earnings statements. And in this earnings, they said, hey, you know, we're going to use some of the profit from next quarter and we're going to do something with it. So we're not going to project a 21% earnings growth. We're going to try to go for, it was like a 18 or a 19. So we're talking about a negligible amount of difference in their earnings growth, and it smacked them down like that. So I don't like it when people think they got a grip on earnings and they say, oh, I know it's going to do this. I know. If you know, you go ahead and you put your money on it, but I'm not putting mine on it. Because at the end of the day, you don't know. You don't know. I don't know. So don't pretend that we've got any kind of grasp on it. If our trade lands us too close to earnings, we're probably going to avoid it. And then there's the logic of, well, we can fix most options trades if they start to go bad. That's no big deal. We can fix them, right? We just make adjustments or whatever. But if the options get out of whack at earnings and then we're stuck in them longer just because of that, then we could end up in a trade for months just because we're trying to avoid a loss and we can't fix the trade because of all of this, because of an earnings, right? So as we're going through the Dow today, we're going to run across a lot of these that are a little too close to earnings, or we're going to have to run very short duration trades or longer duration trades so we can get past this window. That's all I'm saying. Not that we can't trade. We just got to make adjustments because we got earnings coming up. So for Apple, we can trade the next 9 days, or we can go all the way out to something like March or April, right? I mean, yeah, February, fine. We got to avoid the January 22 March options because of that earnings. Something like this would be good for the current situation in Apple. It's a back ratio trade. So with Apple being where it is, right around that 180 mark, if we continue to advance to the upside, this trade will make money. The more Apple goes up, the more this trade can make. If we continue to fall from our current location, we'll end up just getting the credit, $275. It does have a very deep valley, $1,200. Don't let that fool you. You can't take a $1,200 loss in this unless you sit in it all the way until expiration, all the way to February. We would not do that, right? We've got a call credit spread in here, and then we have a straight up naked call long in here, the 185. That short leg, the short call, the 170, it can be rolled forward because you know, once you own a long call, the short call can be split apart from this. So if we need to manage it, we can kick that short call forward. So there is ways to adjust it. This is going to take some buying power to do because you've got a $15 wide trade in there, but it doesn't necessarily need to be that wide. If we unlock it, maybe we knock it down to an 80. But you can see now we don't have that protection of credit to the downside. We actually have a debit to the downside, but it's a very minor debit compared to the big loss sitting down here. So I like the 85 better since it does offer some credit to the downside if we happen to be wrong. A trade like this is specifically designed for a runaway market, for a market that is just continuing to advance to the upside, like a Santa Claus rally. What else we got, right? That's got a lot of risk. So a very short duration call credit spread sitting on top of the market, 183. 9 days out, 65 cents credit in a $2.50 wide trade, a little bit of risk. We have a $6.50 expected move, and we're sitting out of the money, not outside of that range, but a pretty good distance. So let's turn that back ratio off and see what that looks like. 185 on the risk side, 65 on the profit side. And as long as we stay below this break-even value of 183.5 or 183.25, right around in there, as long as we stay below that, this is a winning trade. So we don't want to see Apple rally in this. And yes, there is more risk than reward, but that's because it has a higher win rate. And like I talked about in my live streams today, if you have a high probability winning trade, then you're very likely not going to get as much money for it, right? Because if you've got like a trade that has a 90% chance of winning, you should not make as much, right? No risk, no reward. So that's the 182.5, 185. I already have an Apple trade on, so I'm not looking to add an Apple trade today, but I was pointing it out because it's on the Dow list and we are in a setup for a call credit spread. Now, if you want to continue to be bullish on Apple and there's no reason to be bearish, we've got momentum. It's starting to pick back up again. The options implied volatility is beginning to fade again. This made a substantial bounce off of the 20-period moving average, and we came into a resistance. It's like a little micro cup. We're very likely going to see a handle here, and then we're going to continue that march to the upside. Likely, right? We're going to likely continue that march to the upside. So you could look to be bullish. If you're interested in being bullish, you could just straight up buy a call at the 185, spending around $100 for it. And then if you want to back that up, maybe get a little bit of assistance, add a put credit spread using the 180, 175. That offers you the credit that you need to be able to buy those calls, right? So you're going to spend this credit to buy those calls. Of course, if Apple dumps, the calls are going to lose, and so is this put credit spread. But like I said, I'm already long Apple, so I don't need to add an Apple trade. AMGN. Pretty decent recovery up after that spike. We also got an earnings here to deal with. So February is the marker. We're above the 50. We're above the 20. We had a really nice crossover there. I'm going to add distance from MA just because I'm noticing a lot of markets that are a little overrun. They've ran a little too far, and we just want, you know, a little bit of perspective. How far from the 10-week are we? Because, you know, if we get too far away from that moving average, we're very likely going to pause and come back. All right, AMGN. ADR of 2%. Got an IV rank of 16. It's in a bullish trend with upside momentum, and the 5 is greater than the 10. It's from the healthcare industry and biotechnology. The decreasing implied volatility, but suggests that everybody is maintaining their bullish posture, and we've got momentum to the upside. So AMGN. After the exaggerated move that it's been having, I wouldn't mind going short in here, short duration. They're pricing us in, so everybody's still bullish. We're going counter bullish. We're looking at getting $1.39 in credit. AMGN, 9 days out. Since they priced us really well here at the money, almost $1.40, that's more money than I was expecting. We would normally expect to see like $1.25. Since they're willing to give us so much money, I'm willing to take it out a step. That also gets our break even farther away from the money. So we got that one going. On to the next one. American Express. Oh, all right. Was I too fast? So back up here a second. This is the trade that I just put on. It's not filled yet, right? So it's still a working order. AMGN, $1.03 credit using the Jan 7, 227.5, 230. That's the way it goes, guys. I'm not going to hang out, right? We're trying to get some trades on. This is how I trade. Identify the setup, put it on, move on to the next one. We will revisit those and kind of give them a bump, right? Check to see if why they're not getting filled. Is it making a move without us? You know why or what? And then otherwise, just keep on going. So Kyle, the reason I'm focusing on Dow is because they mostly have weekly options. They're household names that everybody would recognize. There's 30 names in the list. It's diverse between different sectors and industries. And that's the long and the short of it right there. I could run a scan and find things with weekly options. That would work. but then we'd be talking about scans and people would want to know like, well, what scan you're going to use? You're going to this moving average or that moving average, or what time frame? And blah. It doesn't matter, right? It doesn't matter. My main criteria is where's earnings and does it have liquidity? Because we can trade anything: long, short, sideways, long and short, but not sideways. We can literally trade anything we want. So where do we start? Where, we need something. And when I was new, the Dow 30 was just a really good watch list to use because I didn't know how to distinguish characteristics of, quote, a good company and a bad company. I didn't know how to distinguish, a long-term bullish trend versus short-term momentum bursts. I didn't know how to do anything, but I knew how to go to a well-defined watch list like the Dow Jones and use that for a benchmark. So that's what I use today. If we went through this list and I didn't find enough trades, we'd swap to the NASDAQ 100 or the S&P 100, or we would swap to a watch list that has weekly options or 52-week highs, 52-week lows. We would just go to a sector that was bullish and look through those names. A million different ways to do this, right? I carry over 200 trades at any one time, so I need to find things to trade. If I can't find them here, then I will find them somewhere else. American Express has earnings quicker than everything else because financials start the next earnings cycle. We're not at the highs. We're not at the lows. We are above the 20, but we're underneath the 50, and there's a lot of weakness here. We've also got this whole thing going on right now with the bonds. Yeah, check that out. And the dollar. So when it comes to financials, we want to tippy toe, right? I want to be very cautious here. We do have a structure from this gap down. The gap was closed already, so that's not an issue. And I'd say we just go above that 170 and take a look at what we got. So we come back in here. We know we either got to go really short duration or we got to really step it out, right? We can't land in January in the later part using those monthly options because we got that earnings. So we're going to have to stand past that. It will be under system replays. Yep. Just like the last one was, these trades will get posted here. We will review them here, fix them here. Everything that I do, it will all be right here. And I do this for the yearly members because, well, you guys deserve more, right? The monthly members, they deserve things and they got what they paid for. But I'm trying to offer you guys something extra. So I created this self-contained little unit. And anybody that has access to this, you will find all of it right here, from entries, exits, trade logic, any kind of management that needs to be done, trade results, live streams, recordings, everything, all here. So we're not likely to see a good value here on the credit side. I don't want this. This is junk. There's no way I'm going to risk $225 to make $25. I'm not overly bullish, but if I can get the same trade with $28 risk, I will do that. So I'm going to go ahead and do that. So we got American Express. We're looking at, I'm going to take this thing out to February. Don't have my 2.5s. Gosh darn it. Let's see what we can get anyways. Yeah. All right, so American Express, that's 180, 185, February 18. It's not filled yet. You can see it's a working order. And yeah, to answer your question, this is not a paper account. It's a live account. I know a lot of places out there, talk about theoretical trades and how it would all work out. And they tell you, oh yeah, you should totally trade this. And then when you ask them, if it's so good, you're trading it with me, right? Oh, no, we're not actually going to trade it. No, we're just telling you, you should trade it. Yeah, screw places like that, right? If it's so good that they want to tell you it's a good trade, why are they not taking it with you, right? So one of the reasons I use Tastyworks is because there is no paper account on Tastyworks. If you see a trade on Tasty, you know that's a live trade. It's a real trade. All right, we're above the 20, underneath the 50. Boeing's had some reasonably decent news lately. It's got a little bit of a sizzle, but not much. 3% ADR. We're really close to that earnings. That earnings is going to be a handicap through this whole thing. The momentum is coming back around and the implied volatility is continuing to fall. I like all of that. We're well off of the yearly high. Now, let's spread this out a little bit on the weekly side. You got that consistent, persistent move to the downside, which makes everybody nervous, right? None of those really line up. And just scribbling. We're still underneath it. I think it's got the potential to do it. The main issue right now is that pivot point right there, and it's not resolved today. So I'm not going to get into Boeing today. I want this resolved. So this will be a good one for tomorrow. Where is this located? I'm not sure what this is. So Kyle, you seem to be in the wrong chat. We're all here in systems chat. It's where I shared the link. Systems chat. And if you're not a yearly member and you don't have access to systems chat where I'm posting all the trades and there's going to be the trade reviews and all of that, okay, then you're in the right spot. That's where you're at. Everybody else is using that chat, not Zoom chat. All right, so you can see Boeing is weak. We had that fade down yesterday. We're underneath that critical level. I want that resolved. Tomorrow may be a really great opportunity for a red to green. Okay, so I want to put this on the watch list for tomorrow, not today, right? It's just, it has the potential, right? But I don't want to get in it today, long or short. I don't want to get in it today. I want it to resolve this issue. If tomorrow is a red to green, we could have a really nice trade opportunity here, right? So what we're going to be looking for in the morning is first, we want to see this go ahead and close red. That would be a good thing. That's going to be our red to green setup. We want a red day today, preferably in the lower portion of the day. And then we want to see a rally up near the open of today or completely outside of today's candle. That would also resolve that black line, that pivot point that I drew at the 205. And our target will be around that 208.86 area. I'd actually be buying like the 210 calls on that. But I don't want it today. I'm going to move on. I've already got calls in Caterpillar. We're right up against this level. I'm not looking to add to the amount of risk that I'm already carrying, but we're bullish. We got momentum. We're above the 10 and the 50 and the 20. So we've got momentum, trend. We're against the top of the range. We've had 3 days of sideways activity where it's just winding up energy. This thing is ready to go. I'd really like to see that 20 cross the 50, but I wouldn't wait for it. If I wasn't already in this, I would be looking for a better trade. I think the best way to do this, I'm not going to add another one because I've got one. But if you want a Caterpillar trade, it has earnings on February 4, so we can use the Jan 21s. That's a little close, but it would work. And at the money put credit spread would be the way to go. Notice you're getting more than $1.25 in credit, so you're risking 115 to make 135. And if this did not get above that line by Friday, I would just kill the trade. You may take a slight loss. Don't be scared of losses. I see people like upset all the time. Oh, I'm going to take a loss. You're never going to get away from that. This has the potential to make, $70 to $80, and it has the potential to lose $55 to $75. It's almost a 1-to-1. We're right up against the range. And when you go long against the range, you're taking risk. It would be better if we broke out first. But after we break out, everybody's going to pile into it, and you're going to have to chase. Whereas if you get in now and it rejects between now and Friday, it'll start to fall back. You can bail out with a minimal amount of loss. don't even wait around for it. If it doesn't break through by Friday, just cut your losses. They won't be very big. If you wait until Monday, the losses are going to get bigger, waiting and waiting and waiting to see if it's going to break out. Don't do that. 23 days to expiration, 207.5, 210. Try to get filled for anywhere from $1.35 to $1.40. The more this number is, the more money you could make, right? So you don't want a smaller number here. You want a bigger number here. I don't want this one because I've already got Caterpillar trades. Salesforce, I'm already in Salesforce. I posted this as the Bullish Bears. It's still going. We are short in that. Here, 265, 270, got it for $1.46. It's up $45. So I don't need another one there. That was a nice 20 line rejection. If you're looking for a play tomorrow, you got an either or setup. Either or setups are kind of cool because you can go either direction. It's a red day. So you could say, all right, tomorrow, if we rally up in the pre-market and we open near today's open, then you can take a day trade running this up to 260 to the upside, just buy calls. If we close today and go to open tomorrow underneath that 254, you could take a short and run it down to 250, right? Either or play. For a swing, kind of not there, right? Cisco Systems, what a runaway market. I think I put one in here today that didn't get filled. Let's see if I. Nope. All right, so maybe it was just one that I had talked about and I didn't actually get on. So Cisco Systems, runaway market. When is this thing going to stop? Right, it's the same thing that we did in Costco. We went long, even though Costco had already been running a long ways. The problem is we got into Costco a lot sooner, and this really has just continued to run and run and run. All earnings. Had earnings, ran away. I don't want to go long now. Look at the implied volatility. Even the market is saying, come on, man. You've gone about as far as you should go, right? Got dividend coming up. Oh, earnings is way out in February. All right, well, the market does not like it, right? It's getting skittish. Strong momentum. Really kind of bucked the system here. I'd say short across the top. Earnings is in February, so we actually want to use Jan or less. Start with the 16s. Something like $63, $68. I don't have 68 showing, so I chose 67, but we want 68. $5 wide is $1.26. Our break even would be 64.25. Yeah, 64.25. So as long as we stay underneath 64.25, this trade would be a profitable trade. Kind of measure this out real quick. So, you have a range bound market. You got a breakout of that range. First, pull back after the breakout, snap the fibs, see if you've made it to the next level yet, which we did. Move the fib to the new level. It actually has a little more room to run. 64.79 is likely the next spot before it stops, but I'd rather go short now. That's a good question. So when you're looking at the options chain, you could start with something like where's at the money, right? And for my options chain, yellow is in the money, white is out of the money. When I go to build the trade, I know that if I balance it right in the middle, one in, one out, then I'm going to be priced right in the middle. I'm 50 cents wide and I got half of that. So if I start to make it bigger using something like 63, 64, now I'm $1 wide instead of 50 cents wide. I've still got half of it. I can make it a little bigger still, 62.5 and 64.5. So now we're $2 wide. I've still got half of it. Notice how everything is pairing really nice. I'm landing right in the middle. But what if I really didn't actually want to land in the middle? What if I wanted to skew it a little bit one way or the other? So this is a $2 wide trade, and they're offering a little more than $1.10 credit, but my break even comes from taking the short call and adding my credit to it. So that's 63.60 for break even. Well, we would actually need the market to fall for that. I don't want a trade that needs the market to do something, so I need this break even to be higher up, which means I need to start sooner than the 62.5. Well, if I come back up to 63, how wide do I want it? The wider the trade, the more money we have at risk and the more money we could make in profit. The narrower the trade, the less risk and the less profit. So we can make it small and then put 5 of them on, or we could make it bigger and put less of them on, but we're still in control of the risk, right? Either way. So I like $3 to $5 because of my account size. 3 to 5 is kind of comfortable. If you wanted it smaller, you would want to, build it to a size that is comparable for your stomach of risk. What you don't want to do is have to bail out of a trade because the loss is starting to scare you, right? I don't lose sleep at night if the trade is going to lose a negligible amount. Like, oh my gosh, I'm going to lose $20. I don't care. I'm going to sleep. But if I go to sleep tonight and I'm thinking, oh man, that trade's got like $9,000 risk. I really hope the market doesn't crash tomorrow. I'm not going to sleep good. I'm going to freak out all night long. And yet to somebody else, $1,000 may be nothing. They're like, what? You're worried about $1,000? I don't care. Good for them, right? So make it fit your size. I know that I want one in the money and I want one out of the money. And where I balance the trade will give me my break even. Where do I want my break even? I want it above the current price of 63.85. So I'll start with 63 and I'll use 68. That's a $5 wide trade for $1.28. I would like to see 1/3 the risk, which should be around $1.66, and this isn't it. It's only $1.28, but it's close. And in the perfect world, we would get $1.66, but this isn't the perfect world. So I have to either give something up or take it with $1.28. If we take that $1.28, add it to the 63 cents, it's a break even of 64.28. That is above the current market. 64.28 would put us up here somewhere. And so we actually have the weekly high as an area of resistance to kind of help protect us against the market rallying up and hitting our position. Why that didn't show up over here. ThinkorSwim does goofy things sometimes. Hey, there it is. So that would be the bearish play. But what if we're bullish? So in this bearish trade, we're risking 375 to make 125. Cut all of those in half. Say we're looking to make $60 and we're willing to risk 150. It's not great, but smaller numbers. That's bearish. What if we actually did go bullish? Even though the market has already ran like a mad demon, what if we joined it? Could we do it with less risk? Because if we can, I mean, that's a $6 debit. That is literally saying if everything goes completely wrong, we're going to lose $6. I don't like to lose, but I'm not going to lose sleep about $6. We could even get 10 of these and put $60 on the line and then fade them if it continues to rally to the upside. What would it take for this to make $1? Well, a hard move in the right direction would do it. Adding the expected move. So 63, 64, 65, add the 50 cents, that'd get us to 66. That'd be a $2 strike change. So let's just price what that would look like. It would be if we had bought a 65, 67. So it would make 33 cents. If you buy something for $6 and you sell it for $30, you made 300% profit. That's actually not bad either. See what else we can get. All right, this is a $1 wide trade, risking 44 cents to make 55 cents, give or take. You could decide to cut it loose at around half of its loss or half of its profit, whichever way you go, meaning you're risking about $25 to make 30 something, maybe. It's almost a 1-to-1. So if you're bullish, you could do this. And if you want more risk, you just make it bigger or add more of them. Because if you look at this chart, and if you're thinking, wait, man, you were just talking about bearish, now you're bullish. Well, you know, the reality is nobody knows where the hell this thing is going. It could continue upward with not even a pause, or it could reverse here. It has a 50-50 chance, flip a coin. If you feel that it's gone enough and that it's likely going to reverse, put on the short trade. If you think there's more in it, put on the long one. You're in control of the risk. The long one prices better. Let's say it that way. I'm looking at the implied volatility, however, and investors seem to believe that this thing has gone too far, too fast as well. So I kind of like that short. Now let's just put on a little one. There, it is so wishy-washy. Well, that failed fast. I hate it when it does that. I mean, of course I want to get filled, but I hate it when it does that. I always feel like someone was sitting there and they see my trade and they jump on it and then they giggle, gotcha, sucker. Ah, shoot. I'm the sucker. It always freaks me out when it fills fast. Really nice move in Chevron the last few days. Energy's been fun all year. We came out of that range. We've got an expanding market. If you've ever watched any videos on the strat, they talk about markets aggregate, just like that. Let's kind of zoom in here a little bit. See this monster move that we had on Monday, and then we stalled. We've been kind of fading back on the play. I'd really like to see us resolve this big candle before I get into a trade. That's the controlling candle. We would look at it as an inside day, But when it's a really big monster candle, there's no value in that kind of an inside day. We want inside days when they're really compressed like that. Because then when we come out of those, we're very likely to make really big moves. But when we are inside of a really big candle, nah. So nothing here until we resolve this really big candle. Or bounce on the 20, that would work. Disney, consistent, persistent move to the downside. And everybody said, oh yeah, we're gonna fill that gap. Yeah, eventually, maybe, probably. Not anytime soon. We're still underneath the 50, although we did manage to get back above the 20. We got to get that breakout play, right? So, you know, we've got this really clean, really clear, higher low, higher high. That is like the very definition of trend. We're inside yesterday's price, so it's taking a little bit of a breather after that nice move up off of the lows. This thing has gone like $10, right? From 145 to 155. It's impressive. It's very likely going to take a break. Let's price the top of this range and see what they're offering for 164 area. So we don't have a 164. We got a 162 half, 165. If we were to buy way out there, we're looking at a $2.50 wide trade for 30 cents. Sucker. All right, for anybody who does not want that yet, and they're thinking there could be another play, if we reject on that 50, you could take a short there. I don't know that we're going to reject. I don't know if we're going to make it through that or reject off of it or what, but for 38 cents, I'm willing to take a try, because the worst that happens is I'm going to lose 38 cents. And if we start to fade in the next day or two, we're just going to close that trade and move on. We won't even take the full 38-cent loss, right? Maybe we take $10 loss. Now move on. So what? That thing has the potential to make over $100. I'm willing to risk $10 to $15 for a chance to make $100. Sure. Dow Chemical, micro double bottom, coming up off of that low. We just made it above the 50. Woohoo! Implied volatility continuing to decline, so investors are not yet concerned. Momentum is back above the zero line. It's curling over a little, not much, but we still got the histogram pointed in the right direction. We have support now at the 56. Let's see what that price is. Oh, where's that earnings at? January 27th. Go back the other way. All right, so nothing in January. Let's try February. No way, that ain't happening. I mean, that's a little bit better. So there's 1/3, right? We're looking for like $1.66 and a $5 trade. That's $1.72. This would be a put credit spread $5 wide for $1.72 in credit. So we're basically risking 3 1/4 to make 1 3/4. It's not bad. It can be managed if needed, but I don't know that I would manage it. The idea here is that if it begins to reject, we just dump the play, right? Just get the heck out. So what would dump the play look like? Well, it's supposed to hold $56. Doing it again. It's supposed to hold $56. So if we fail the rally and we start to dump and it falls below $66, we get the heck out, right? Just cut bait and run. We could look for this to pause rather than being bullish. We could just say that we're likely to see it not continue to make a move in the next few days, run something bearish, counter trend, and or run something like an iron condor. So let's see what an iron condor would cost, right? And the reason the iron comes into play is you've got a little bit of protection. So, you know, like I'm putting on a credit spread on the call side. That's half of the iron condor. Suppose this continues to rally up and threatens those calls. Well, we would also have puts on. And we could roll those puts up to get more credit, right? So the idea would be we let the calls lose, but we also increase those money on the put side to cover the loss. So this iron condor is pricing at $1.55, risking $3.45. It's not exactly that 1/3 the risk, but for an iron, that's not bad at all. The gray area is the expected move, February 18, February 19 up here, showing that gray area. We can plot the break even on the chart, kind of get an idea of what that looks like, and then set that on the chart. So we got their line instead of mine. So let's just delete this junk. And there's the line. So that's the iron condor. As long as it stays in this box, we would be making money. If it broke to the upside, we roll the puts up. If it breaks to the downside, we roll the calls down. No problem, right? So let's go get those numbers. That's Feb 18. Ah, heck, I'm not going to remember that. I'll just, thank goodness for multiple screens. All right. So we've got, I'll post the screenshot or like bring the broker back over after I build this. Feb 18. We have the 60 and the 65, and then we have 52.5 and 47.5. $1.58, $1.55. All right, so here's the trade, February 18, 51 days out, that wide. The orange bar here shows us where the expected move is. It's nice. 344 max loss, 156 max profit, 71% chance of hitting 50% profit. Good to go. Let that stew. Let me give it a picture of it for you so you know what we're working with. And we're going to pause for a second and regroup on those other ones that we've been building. We want to resubmit them and see if we can see if they need adjusted, right? Like we don't, oh, I already had a Dow trade on. Yeah, whatever. Whatever. Doesn't matter. So this June 17 stuff up here, just ignore that. I already had that on. It's just Dow with this February series iron condor. All right, so let's revisit some of those others and see why they're not filled yet. AMGN working order. We're just going to hit replace, unlock, and see if it's moved. Nothing yet. Nothing changed. I call that bumping. I'm sure they got a better name for it. I don't have a better name for it. Just going in and kicking the broker and asking, hey, you guys see this, right? You didn't forget about me? Let's see what else we got. Let's just turn off everything but the working ones. AMGN, American Express, and Dow. That's it. Yeah, I guess the rest got filled, right? Okay, that was easy. That was fast enough. On to the next one. Goldman Sachs. I'm in Goldman Sachs, but we could revisit this. So the Goldman Sachs trade that I am in, I have a long call that's not doing too good. And just today, I sold a short call against it. So the short call is going to expire January 21. I collected $475 for it. Oh, something got filled. AMGN. So we're long that now. It's no longer a maybe. I'll go ahead and post this picture so that we know that it got filled. That was 103 in credit. We know that it's credit because it's in green, right? So that did get filled. Let me just scroll up and delete the old one because that was no longer working, right? It's filled. So we're in Cisco Systems and Disney and AMGN. Goldman Sachs had a really amazing year. And this is a classic distribution pattern. Well, I don't know. Say it. I don't know which way you want to say it. See, I went and cleaned out all my pictures because I was going to reset my PC, and now I can't find the pictures that I'm looking for. So there is a classic accumulation and distribution pattern. This is accumulation, and now we're sideways. This sideways area can be a topping pattern. We're talking about, like daily charts, weekly charts, but the pattern exists everywhere. This could be a top, or it could be what IBD calls like a base, and it could stay in this base for like a year, just sitting there accumulating, and then coming out of that and continuing in its advance to the upside. We just don't know, right? Nobody knows in the grand scheme of things. But if you look at where Goldman was, it spent a lot of time down here, a lot of time. That's 2 years that it just stayed right there. And then this year, it finally, it just come out of there, and then away it went. Well, we're getting that topping pattern again. So we're very likely at the low of this range. We've just bounced the 50, working our way back up, and we're likely just to dribble there again between 368 and 425. For how long, right? I mean, like day, week, year, month. Nobody knows. The main thing is we're coming up off of that low. We got earnings to worry about. We just crossed that 20, which is fine, but we're still underneath the 50. And I don't know, it's weak, right? It's weak. It's not looking good. We don't have a lot of love here to focus on. And generally speaking, when a market goes down, volatility should go up. Volatility is not going up. It's going down with price. That's not the way it's supposed to work. So I would say that we just step aside and not trade that. Move on to the next one. Home Depot. These options in Home Depot, I mean, I've traded them, but they're junk, right? So let's just come over and take a good look at what junk looks like. The mark, the mid, $7.75. That's not too bad out of the money. You start going a little deeper, right? That's a 40-cent spread, still not bad. One more strike up, 50 cents wide. 50 cents wide. That's $50 slipping. Just one strike. We need two if we're going to do a spread. So I have traded these. I will trade them again. But man, it's got to give me something good. It has $5 wide strikes, very illiquid, wide bid-ask spread. Like, I mean, it's going to have to give me something, right? It's got to get up early and make coffee. It's got to do something. I don't want it. So what we have right now is like this little micro breakout little V bottom bounce off the 50. We got back above the 20. Just today, we got some of that love, right? It's a $1, excuse me, a 1% move. I'm not feeling it. If we had caught it early enough to have like a day trade that extended into a swing trade, great. If we had caught that red to green, that'd have been beautiful. Look at that red to green setup right there. Closed red, rallied in the pre-market higher than the previous day's open, bounced on the institutional pivot and rallied like a mad demon all the way through that 20 period moving average. I would have kept that as a swing trade. But getting in it today, I'm not with that. The options are just not good enough. If you want to, I mean, if you've got the account size for it, this would be a great iron condor setup, right? And by saying account size, I mean, these things are pricey. For, someone with a smaller account, you would not want to trade this thing. So something like the 420, 425, and then something like the 405, 400. Notice it's a $5 wide trade, and we've got like $4 credit. Heck, for that, I may get it. Normally, I would just avoid the heck out of this thing. See, that's why. Look how wide the expected move is and how narrow our iron condor is. So let's start bumping it and see what we end up with. We'll go to like a 390, 395. Got to unlock the trade. And we'll go to a 430 and a 425. Okay, I mean, that's not bad. 275 versus 225. We're still inside of the expected move, or the one standard deviation. That's a more appropriate way to say it. We're still inside of that, but we've got more of a one-to-one. I'd even be willing to make it a little more, but first ask, where do we see more risk? A downside fall or an upside break? I'd say a downside fall. So instead of being delta neutral, instead of building it in the middle, maybe we skew it a little bit to one side or the other. And I'd say skew the put side. So we're going to use something like, let's try the 385, 390. That puts us right on the line, 250 for 250, right? Notice I'm no longer in the middle. It kind of gave me a little upside bullish play. So this is risking 250 to make 250. It's going to expire Feb 18. Where's that earnings? Oh, see, we had earnings in November. So the next one shouldn't be until like February. Normally I would just avoid Home Depot, but if it's going to give it to us, yeah. Let's get those spread. Oop. So we have a 425, 430. Oh, that's right on earnings. Feb 18 and earnings Feb 18. So we do not want that. Right? Let's see if we can readjust for January, because we don't want this. All right, $1.45. Yeah, that really whacked it down. $1.45 credit. The reason we're getting less credit now is because we have a much higher chance of it being a successful trade. Remember, the greater your chances of winning, the less money you're likely to see in the win. That makes sense, right? So, yeah. I don't like it as much. See what else we can do with it. I don't like that much risk. It's fine. Let's plot it out there and then kind of reevaluate it. So we'll first set the break evens. Means we move the lines. And then we set those lines on the chart. And that's what we get. A downside break should put us with a bounce at around the 50. And an upside break would first need to get through the yearly high. That's not a bad situation. And it's 20-something days. 23 days to expiration. So 425, 430. And 385, 390. Wow, we're really out there. 390, 385. So this is the trade when I got it built, right? And you can see how off kilter we are. To me, I perceive more risk to the downside, so I made the downside farther out. But we could, bring that forward a little bit, right? Notice when I did, it's still, well, it's no longer $5 wide. We got to go a little bit more. There we go. $5 wide still. We got a little bit more credit for it, but we didn't really gain much. We got a fractional amount, $20 more, but we took a lot more risk now. So, I mean, if we're going to get that much credit being way out there, why not just go ahead and, did you see that? I actually get more credit out there. So we've got an inverted skew. Notice it's $1.82. Oh, never mind. It's $5 wide. There we go. That makes more sense. I was about to say we got an inverted skew. Check it out. All right. So $1.46, $5 wide. We're risking 350 to make 150. And we're buffering the downside. If we wanted to use the expected move, we could do something like that. But I mean, are we really getting much for it? And our trade management will be, if it falls down, we roll the calls down after it. If it rallies and runs through our calls, we roll the puts up after it. So Home Depot, that's working. Let's look at the open interest here. I didn't, but we want to. So that 392.5, that's actually one of our strikes. It doesn't have a lot of open interest, only 79 trades there. And the 397.5 only has 129 trades there. But if we'd have gone one more strike to the round number, 1.7, and that's because people like round numbers. It makes it easier for them, especially people who are uncomfortable with options and they're trying to calculate like rounding and adding the zeros. And generally speaking, you get a worse price on round numbers. Tom Sosnoff actually made a comment about that once during an interview, but he had a phrase for it. He called it the street strike or something. I don't remember it, but he's the one that got my attention on it. He's like, just do yourself a favor and avoid round numbers. He basically said that's where the suckers go, or people who can't do math, or people that are new to options, or, he doesn't talk like that. You know what I mean? Like, he's a nice guy. I may say something like that. He wouldn't say something like that. But it's likely we won't get filled because of those two strikes. We'll just let it rest and see what we get. Oh, let me take a picture. All right. So we've got a few working orders and we got some trades on. We still got, man, it's already 2 o'clock. We're about halfway through the list. Honeywell, tight on earnings, still underneath the momentum. Rally up has been decreasing implied volatility. The 24th, so we're going to have to just jump right past the January monthly earnings cycle. Look at that clean downward trend, right? That thing's just been on a rip to the downside. We've got a structural low down here that has not been tested yet. Very likely we're going to test that. We're inside day today. I would be looking for tomorrow to offer an opportunity like a red to green. This is a really nice inside day with a red day too. So tomorrow would be a phenomenal trade opportunity. I'm going to let that play out before I want to take a trade here. Wow, generous move in IBM. Closed the gap today. We're really darn close to it. Not yet, right? Really, really close to closing the gap. Implied volatility kind of picked up a little bit. The amazing thing here is in this rally up, that implied volatility really came up with it. So investors were getting really concerned at the top of this range back here. And when we managed to break through that, then they lost their concern, like, oh, yay, hey, we made it through. So this is reflecting their exuberance, like, woohoo, we made it. But now we're at the next one. And we're really close to earnings. Let's see what they look like. I don't want to just say no. Now, see, it had, I don't know, a split. Either they absorbed a company or they had a stock split or something. That's what we're seeing here in the options chain. I hate it when they do that. Nah. Intel. I think I got to trade on Intel. Yep. Iron Condor already loaded. Still doing good. Johnson & Johnson. That's actually a pretty nice price. So very short duration at the money, call credit spread with a bias that says, I bet you don't go any higher than this. It's a very, very short duration. This has a break even of 171.53 and we're at 171.58. So this trade is really drawing a line in the sand and saying, I bet today is as high as you get and that we fall back down tomorrow. If we're wrong, this very short duration trade is going to lose very fast. But it's $2.50 wide. You're risking $1 to make $1.50. You could get out without losing the full dollar. I don't see any reason why you couldn't, but you're going to lose a large part of it if you're wrong, right? At least half of that dollar. On the other hand, if you're right, this is going to deflect right away. You'll know it right away. It'll start to fall literally tomorrow, right? Because it cannot go higher than today. Feel free to ask questions, guys. This is for your benefit as much as mine. I would be putting these trades on whether I was streaming or not. This is basically what I do in the afternoon. I flip through the charts and I ask, hey, you got a trade in here? Let's do that, right? And really, I mean, that's it. You know what I mean? Like, it's either going to work or it won't. We either have control of the risk or we don't. There are a few minor details that kind of stand out sometimes that warn me and say, nope, nope, nope. Otherwise, do it and move on, right? Just go to the next one, go to the next one. Don't fall in love with the trade. If it starts to go bad, get the heck out. And like I said, I would be doing this whether you were here or not. The idea is that if I'm going to be doing it anyways, why not do it live so that you guys can see what I'm doing? I'm not spending massive amounts of time analyzing indicators and, drawing out patterns and planning the day before is a lot harder to do. And that often is because we don't know what's going to move in the overnight hours and then where the investor's exuberance is going to be tomorrow. So it's easier to start your day with a pre-market than it is to try to plan ahead. Where I have stopped and said, hey, this will be good for tomorrow, it's because I'm literally seeing something in 2 candles, right? Like JP Morgan. I don't want JP Morgan today, but this would be great for tomorrow. We have a red day, we're inside day, we're underneath the structural level, and we just got back above the 20. If we rally up in the pre-market above this day's high, or even just enough, depending on where we close, if we can rally up just to today's open and then rally up to the 160, that'd be a great trade for tomorrow. So there are a few things that I may look for like that. But for the most part, I used to do that kind of work. I would come into the office at night and I would review charts and draw trend lines and, look at the big picture. And I would spend hours getting ready for tomorrow. I have a whole watch list full of like cup and handle, head and shoulders, flags. I'm ready. Yeah. And then the next day, none of that crap would move. And everything in the pre-market that was moving was nothing on my list. So I got to the point where I quit doing that work. It just, there was no, I wasn't getting paid for my effort. You know what I mean? I was doing all that work for nothing. So now I just start it in the pre-market. I come in the pre-market, I look at what's moving, and I ask the questions instead. All right, what's moving? What has a trade? If I don't see anything that I like in the pre-market, or just like I am right now, I come in the afternoon, bring up a watch list and start flipping through it. We can trade anything, long, short, sideways. We can trade anything. So every single chart that I bring up is a tradable chart, as long as it meets some of my own little personal requirements. It needs weekly options. I don't want to see massive gaps, no runaway markets, no parabolic markets. It's just like some very basic criteria that says avoid this stuff. And as long as I don't see that stuff, I'm good to go. Let's get her. And then I go put the trade on. I'm trying to stay as diverse as possible. I don't want a whole portfolio of long trades, and I don't want a whole portfolio of shorts. I don't want them all in the same sector or the same industry. And I'm trying to spread their size out as well so that they're not all really big or all really small. I'm trying to keep it as diverse as possible, which is why the Dow Jones is a really good list to start with. It is really diverse, and they're household names. Most of these names. Even a new trader knows most of these names, even if they don't recognize the symbol. Hey, we got Field and Johnson & Johnson. So let's go over there and take that picture, and we will erase the old picture. So this is a call credit spread for New Year's Eve, 2 days away. It is literally going to win or lose. And we will know by how we open tomorrow. So if it really just starts to fail, cut bait and get out. Take a little bit of a loss, yes, but we don't have to take the full loss. So the main thing is you're in full control of the size of the trade and then where you place it, at the money or out of the money. And depending on those choices, it will have more risk or less risk. It will demand more out of the market before you can win or less. You adjust it to meet your own personal comfort and let it ride. One thing that really surprised me was watching CMT analysts with 30 years experience. They would take a chart that looked like this, and they would zoom in and say, all right, let's go ahead and put on a trade here. And they would only be looking at that. Like, what are you guys doing, man? You can't see anything. How do you know where support and resistance and trend and structure, and what if that's a head and shoulders or a cup and handle? What? And they're like, what's going to happen in the next 3 days? It's going to go up or it's going to go down. And it's all really going to be dependent on those pivots that are right there. They're right. They really are right. And so, yeah, I mean, in the grand scheme of things, the big picture matters. But to get to that zoomed in chart, I had to start out here anyways. So if it was sitting at the low of that range, I would be treating it different when I zoomed in. If it was sitting at the high of the range, I would be treating it differently when I zoomed in, right? So at the end of it all, we have our go-tos that work, right? We can say, well, I only want iron condors, or I only want credits, or, whatever. We all have our sweet spots. Do the thing that suits you the best risk-wise, Don't worry about money yet. Worry about risk. Can you identify it? How much is it? Can you sleep at night? Right? Yep. I hear it all the time. I totally hear that all the time. Everybody gets caught up in the details. One of the things that I recommend, turn everything off. I promise, turn everything off. Get those charts completely naked. Forget multiple time frames, forget indicators, just strip everything off. Start with that. Because if you can't see the trade here, none of the other stuff is going to help you, which, by the way, none of the other stuff is going to help you anyways. If the trade's going to fail, it will fail. It would not matter if you had the best RSI or the best MACD or the best moving average, the EMA, the SMA, the 20, the 50. It won't matter. If it's going to fail tomorrow, it's going to be because investors bailed out of JP Morgan tomorrow. It won't be because of that indicator. So that thing is nothing more than a distraction. You can use those to confirm what you believe, like, oh, I think this has momentum. How much momentum? A 35. Oh, okay, now you've got a value that you can lean on and say, this, I'm going to take trades that are at least a 35 momentum, right? And you can quantify that in a statement. But would it lose if it had a 34 instead of a 35? I don't think that that would matter, right? Because that momentum isn't what made it win or lose. It's what happened tomorrow. So at the end of the day, don't let those things hold you back. And if you literally just strip everything off of your chart and start there, then later on, when you do add things, the only thing that you add is what you're looking for. So for an example, if I did want to know where the momentum is here, how much momentum does this have? Or does it have any at all? I can turn on an indicator and measure that and give myself a statement. It has X amount of momentum. Does it have, implied volatility? Of course, yes, it does. But how much of it? And is that volatility increasing or decreasing? Then I can turn on the indicator and I can answer that question. Oh, it has decreasing implied volatility. Examples of a Busby. There was a very ugly Busby today on the NASDAQ on the intraday, but before we even get to the intraday, there's a Busby. We have a range-bound market. We broke out of the range, pulled back, and tagged that range. That's a Busby. Coke. I think Coke was another one that I mentioned was a Busby, but it didn't pan out, right? So when I mentioned Coke, we had this 5-minute open range that looked like that. And Coke was just coming up to that right there. There's a Busby. There's where I said, hey, we got a Busby on Coke. But it broke through the range and continued to go up. The Busby never materialized. If it had just come up and hit there and then started to continue that move to the downside, that would have been a Busby. But there is no Busby because it continued to go. It ran right through. So here was the NASDAQ. And the NASDAQ had this really big range. And the Busby that I referred to here was this rally back up to bump off of the bottom of that range. That's a Busby. We got one formed here, although it's not a very good one. Test of a range, breakout, pull back, validate the old resistance as new support. That is a Busby. Now there's, just like a head and shoulders, cup and handle, flag, there are good patterns and bad patterns. That's a bad Busby, but it's still a Busby. There's a head and shoulders. It's a very ugly head and shoulders, but it is one. There's a head and shoulders inverted right there. Don't get hung up on the pattern. What does a Busby represent? The beginning of trend. Most often before a trend actually starts to go, it gives you a Busby signal. That's it. It's as simple as that. So here we've got a range. If we were to break out of the top of that range, we could have a potential Busby here. What would it need to do? Break out, pull back, continue the run. There's the peak. There's the confirmation of the Busby. It only owes you back to that. So you would get in there and get out there. Or get most of it out there and hold a runner. In the Art and Science of Technical Analysis, that book written by Grimes, he showed Busby. He didn't call it a Busby. Pre-Busby, entering in the preceding base before the breakout. Or Busby. Breakouts, entering on the first pullback following a Busby or following a breakout. He goes into the trade type, the concept, the setup, the trigger, the reference, the analysis, profit targets, even additional comments. It's a good book. It's worth reading. I shared that book in the book section of the Discord. Same thing to the downside. We had resistance or we had support. Say it either way. So there was support. Price was holding at support, failed support, pulled back against, validated the move before continuing lower. Busby. So that is a good book. I read it multiple times and then I started to take notes. The really cool thing about that book is it's how I trade. I just formed how I trade before I ever read the book. So I would have just done myself a favor if I'd read the book first. But I didn't know that the book existed. So if you go to trading books using that link, scroll up to the top, it's like The Art and Science of Technical Analysis by the man named Grimes. All right, Coca-Cola sitting at the highs. It managed a new breakout today. Exuberant run off of that gap close, nice little bounce play. Really don't know what to do with it, right? IBD would say something like, oh, well, that's a buy. It's in a buy zone after coming out of the base. And I can halfway agree with them, but not with an options trade, right? If I was doing stock, yeah, sure, why not? When it comes to options, if this thing fails here or just kind of stalls there, it's going to suck, right? So other than putting on something like a back ratio trade, I wouldn't know what else to do with it. Because we're literally right in the middle of nowhere. Now, the nice thing about options is, you know, if they're cheap enough, we can do something with it anyways, right? Kind of go, I don't know, say March, and we spend $125 or so to buy a call. And if it fails to materialize, then we can at least sell calls against it. So that's a March 18, 60 strike call. For $1.25. The natural price is $1.27. I'm not going to pay $1.27. I'll pay $1.25. So working order. Not yet filled. Just going to go in and bump these. We got a Dow trade on deck. Just giving it a bump, see if it gets filled. And Home Depot, give it a bump. Johnson & Johnson, we got filled. American Express, that was the other one. So, you know, we put on a pretty good number of trades today, depending on your risk or the size of your account. Maybe you took some, maybe you didn't. Hopefully you find familiarity with this, you know, the more we do it. And we're going to be doing it a lot more once Tim takes my morning streams. That we come in the afternoon, find opportunities to trade, evaluate markets, and look for an opportunity. Right now, I went through these pretty fast because, well, I'm trying to get trades on, but it won't always be that way. There are going to be days where there's just nothing we want to trade, and those will be great learning days. You know, we can talk about different things and kind of nerd out on the options language, and you know, just go full on nerd. Other days like today, it was about getting some trades on. You know, I've been kind of holding back, waiting for the volatility around Christmas and the New Year's and the shortened weeks, and yeah, we're finally getting on the other side of that. Time to get some trades going. 3M, right up against that range again. Be looking for that to do something tomorrow. Not looking at it today. No way. I'm already holding Microsoft. So this is a really good example of a chart that you should probably avoid or trade in small durations. Nike. Look at this thing for the year. Big sweeping lows to $125, big sweeping highs up to 180. This thing has been all over the place. Massive rally at earnings. All went to hell, rallied back up again after earnings, sank back down halfway, and now it's coming back up again. This thing doesn't know what it wants, right? It's just a mess. This is a really great example of stuff that I say I don't like to trade on a general basis. Long-term swing trades, you know, 2 months out, things like that, I would not trade this. Short duration, oh yeah, this thing can move. You know, right now we're stuck inside of this really, really big doji. But we've got a lot of days in a row that are in this next candle smaller. That's the one that has my attention right now. So today was a red to green, but a sorry one, right? We didn't get anything out of it. I'd be watching for this to materialize by the end of the week and try to get it above that doji day. I just don't see a play here. A day trade that leads to a swing, yeah, I could see that, but just trying to swing it, I don't need to. Procter & Gamble, nice follow through. Look at all those days in a row, right? Nobody's going against Procter & Gamble. Me neither. Travelers does not have weekly options. UNH. Nosebleed sections, man. Beautiful play, though. Just nothing to do with it unless you want to just straight up buy a call. See, the problem is it's already made a really big move. So then you have to take your lump and buy it at the highs or wait for it to pull back. And it is a momentum play. And we're supposed to be willing to buy high, sell higher in momentum. but I'm just not comfortable doing it. It's just too expensive, too big, too far. I don't want it. Visa. This thing is sorry. Every time I try to trade this, the strikes are a pain in the bum, really wide. You know, it's just, it seems I can't get rolls. I can't get fills. I always have troubles trading Visa. And Verizon's worse. I mean, I don't know what's up with Verizon. This thing is just madness to trade. And look at, it's got a really nice spread right now. That's not bad. It's got liquidity to a point, you know, kind of keep it at the money. I always laugh when people say, "Oh, I took a loss in you know, XYZ company. I don't trade that anymore." It wasn't that company's fault you took a loss. So I don't, you know, like have a no trade list just because I happen to have taken a loss in something. But I do recognize where I happen to have troubles again and again and again, like the dollar, UDP. Every time I trade that, I get assigned. Every time I trade it, I get assigned. Well, you know, after a while, I just quit trading the darn thing because I'm tired of getting assigned. But I literally heard a quote professional trader just the other day say, "Oh yeah, no, I don't trade that. I took a really big loss in that when I was new, and now it's on my no trade list." Well, why? And it was like AMD. So they wrote off ever trading AMD because AMD kicked them in the face when they were new and they didn't know any better and took a dumb trade that cost them a lot of money. Yeah, no, I don't trade AMD. I lost really big once when I was new. It's not AMD's fault. But you should get into a habit of recognizing when you take consistent issues, like getting assigned all the time in the dollar. I quit trading the dollar because of that. Now, if I want to trade the dollar, I use the smalls. That's the way to go. All right, we made it to the end of the Dow list. The Dow list isn't anything special or amazing or popular. It's just 30 names, right? Diverse, liquid names with nice setups. And if Tim comes in on the new year and starts taking over my morning streams, we will be doing these afternoon streams more often. It didn't take us too long to get through all the names either. It's only 2:30, so it's like an hour and a half. I will be following up with videos and pictures and posts. Any adjustments that I make to any of these trades, or if we should get filled by the end of the day, I will update the pictures. The videos will be posted in the system replays. The trade histories will show up here because I'll be coming in and posting all of the ones that got filled today in here. If they didn't get filled by the end of the day, they won't be in this list. Guys, if you got questions, there's a spot for it, right? System support, just reach out here. You can use the chat too, by all means, you know, either one. But if you get stuck, you got problems, use this. That way it doesn't get buried in the chat. I know it's kind of a joke. The chat's not really chatty, but it's the point of it, right? Now it may not be chatty, but you know, I could get into a conversation with someone and then we have like a 2-hour talk and your question gets buried way in the back. If you're in a trade and you need a question answered, this is a better place to put it because then I'll see it. I'll be able to help you with it. And there's no reason for you to stay in a trade that's upsetting you, not knowing what to do about it, right? I don't want to feel that way. I don't want you to feel that way. If you're in something, you're stuck. And especially if it's one that we put on, reach out. Let's see what we can do to fix it. Sometimes losers are just losers. So, you know, be prepared for that answer. But a lot of times we can try to do something with it. Hey, everybody, enjoy your day. I'm going to get off of here and I'll see y'all later. All right, so before we go, Victor asked about MU. I almost didn't see that, Victor. Probably want to use the regular chat. That way we don't miss your questions. All right, MU, multi-year runner. from the absolute lows back up to the absolute highs. What an amazing move in this thing, right? This is a part of the chip sector. And in the last few days, it has made a substantial move. That is a really good place to short that sucker. So tell me that you were thinking the same thing. You were thinking, oh man, this looks like a really great thing to short right now. Yeah, that's exactly what you were thinking, right? Distance from its moving average. This is asking how far away from the 10-period weekly moving average are we? We are at 16.2. How many times has it reversed when it got that far away from the moving average? We're at the extremes. We're higher than it's been in the last year. We are farther away from that moving average than we have been in the past year. But how about the past 3 years? So we did go farther than that before. We were in the 30s, 30% away from a 10-period moving average. That is a monster move. And it's when we came out of that base, right? So we had that like multi-year base, and then it just rallied like a mad demon from 50 to 100 almost. So what this is telling us is that this thing can make exaggerated moves, right? It has before, it will again. And should we short this sucker? Well, it's sitting at the highs, which normally is where we say, yeah, that's a good time to do it. But is there any signal, any warning, anything that can help convince us that this is a good place to go short, other than just our own bias that says, well, when we're at the highs, it's what we do? Investors are not concerned. Notice that as we ran higher, the implied volatility from earnings is messing everything up, but we had the earnings dump, and then we just went sideways. So it's not holding a lot of concern. Had a beautiful red to green today. Hey, guys, if you're talking about a red to green setup, this is exactly what it's supposed to look like. We closed red yesterday, opened today higher than the previous day's open, and even better, higher than yesterday's highest point. And then we faded down, bounced perfectly on top of that institutional pivot point, and ran like a mad demon, more than 4% probably before it faded back. No, just a 3% move, right? But from its close, 4%. There you go. From where we closed yesterday to the high of today, a 4% move. Perfect, spot on example of a red to green. And I would not short this now, right? Why? Because it just had a perfect bullish momentum play. I had to at least let that play out before thinking about shorting it. That's almost a textbook perfect. If I wanted to make a commercial on what a red to green looked like, it would look like that. You couldn't make it better than that, right? So right now, as much as this feels, quote, overextended, overbought, use whatever words you want, it's not showing any signs that it's done yet. So how do we trade a double top or a double bottom with confirmation? We look for first rejection, right? So normally when you have a range bound, well, when you have anything that's going to hit a pivot, Coke got filled. So when you have anything that's going to hit a pivot, say a double top in this place, first touch should give you a soft rejection. So we would expect at least one soft rejection before breaking through. When it's not a soft rejection and it's a hard rejection, it's very, very obvious and very clear, right? So back here, for an example, notice that really big, deep, dark rejection. That was a smackdown. That was like, screw you, get out of here. Just smack down, really hard, deep rejection. We want to see that. If we don't see that deep rejection, then we're not getting a reversal here yet. The next thing about double tops and double bottoms is IBD's logic. So when it comes to that, IBD says, hey, a double top or a double bottom should not be perfectly centered on the previous pivot point, right? They say, your market comes down, it sets that pivot. The next time it comes down, it should not stop equally. It should go deeper and then bounce, because double tops and double bottoms are designed to shake out weak hands. They deliberately go farther than the other one first and then reject. So even if we use just plain old double bottom, double top logic, this is supposed to break through that level first and then reverse. And if it doesn't do that, then it should make you concerned, right? So we go to Investors Business Daily. Bases, power trends, patterns. There are three go-tos: double bottoms, double tops, cup and handles, flat bases. The second leg down undercuts the first leg down. And if I was to flip that over, it would be the same thing in reverse, right? It's supposed to do that. When it doesn't, it should cause you concern. So MU is primed for a reversal. I don't think anybody could argue with that. It has made a really big move, but it's not showing any signs of slowing down yet. This is the acceleration bands made by Price Headley. And what Headley developed these to do is, after that second candle on the breakout, you go long on a weekly chart. So I'm on the weekly for a reason. He used a weekly chart, acceleration bands, and after the second candle close, if it was still bullish, he went long. And you can see how it works out, right? Really nice play. Well, we just got outside of the bands. We're on candle number 2 right now, and the week isn't done. So don't just run out and short this thing because you feel that it's gone too far. Wait for that signal, a hard rejection, or, hey, if you can do it money-wise, keeping your risk small, do it. Like, why not? Forget seeing confirmation. If you can take this trade and risk a number that's comfortable for you, do it. Absolutely. Me, I'm just so stuck and impressed on that red to green that I can't get past that at the moment. I'm so thoroughly enamored with it. I love it. Beautiful. I need like a pinup poster of patterns, and that'd be like March right there, man. Wow. That's sexy. All right, guys. Have a good one.